someone getting into REITs now would have the benefit of the recent underperformance versus S&P in recent years. Betas have been coming down recently. So I think it would be a good time for someone to establish position in REITs in a asset allocation model. We're not market timers, so it's not our bread and butter, but do believe that as folks think about asset allocation, that REITs are worthy of consideration. They're a great vehicle for investing in commercial real estate.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. In this week's episode, I'm speaking with Michael Knott, Green Street's head of US REIT research. Michael brings over 22 years of real estate experience, ranging from investment banking, equity research to private company CFO. And he manages all of Green Street's property and investment research teams. Michael, thanks for joining the podcast today.
Great to be here. Thanks for having me.
So, Michael, maybe we could start by looking at what you consider to be some of the main macro trends that are shaping how REITs are performing today.
Yeah, sure. It's been an interesting year so far. A lot of different cross currents in the market generally and for REITs specifically. But I'd say if you try to narrow it down to a few things, I'd say most importantly, the recent AI scare trade across the overall market, lower interest rates, and then strong access to debt capital for all of commercial real estate, listed and private. I think those have been probably, in my mind, the most important things, providing a bit of a tailwind to REITs so far this year. So REITs have outperformed the S&P by about 900 basis points year to date, which is a little bit of a nice comeback for the industry on a relative basis. It's been a bit of a struggle in recent years on that front, competing with investor capital in broader equity categories. So those things I'd say have been probably the most important drivers for REITs, I would say. And then just to dig into those maybe for a moment or two, rates, probably most important thing to talk about. I think we're close to 4.0 on the 10-year now. So we're down maybe 20, 30 bips in recent weeks. So REITs are, of course, rate sensitive. So that's been a bit of a benefit. And I would say if there was even more expectation building in the market for lower rates or if rates continue to decline, on the long end, that would benefit REITs, of course. So I think that part's important. And that's also important for the overall debt market. Debt capital is, as we know, the lifeblood of commercial real estate, capital intensive industry. Access to debt and attractive cost of debt are both important considerations for how real estate performs and how investors underwrite it. And so access to debt has been great. Costs of debt have been compressing a bit. So I would say that's been really important. And then I think part of the reason for REITs outperforming this year has been the kind of slow start to the year for the S&P. A lot of concerns about the many possible impacts of the AI industry and what will happen and how that will impact all kinds of industries. So a lot of sectors have been hit by that. And so I think there's been a bit of a broad rotation into real life kind of businesses, including REITs. So I think that's been a benefit. But a cross current on the other side has been a lessening outlook on the employment side, I think has been a negative, especially for some sectors in real estate. And we could talk more about that in a minute, I'm sure. But the prospect of worse employment last year than we all thought happened, coupled with maybe lessening expectations for what job growth will be this year, I think have been a cross current for REITs. So I'll stop there and see what else you want to chat about.
Yeah, I wanted to ask how REIT management teams have been responding to all these different factors.
Yeah, no, it's a good question. I would say within REITs, it's hard to paint with a broad brush. There have been some real winners among different sectors and some losers as well. So with over 20 different property types, it's important to drill down into the details, of course, of what the fundamentals are for a given sector in terms of their space demand outlook and cash flow growth prospects and cost of capital, access to capital, all that. So it varies quite a bit from sector to sector across REITs, but I would say there are a few unifying themes probably of how management teams are responding. I'd say one of the newer aspects that a lot of the bigger companies are gravitating to is the idea of fund management and gathering private pools of capital to serve as an alternative source of capital to just public equity to fund their business. So there have been several companies that have done this for a long period of time, but it's been becoming more and more common for the large cap best in class by sector enterprises to get into this business. It's one of those things where it makes these businesses better. It makes the platforms more scalable, all those kinds of things. They need to do it. But Ned, it's not clear yet that it's an obvious benefit for REIT shareholders. Makes the businesses larger, more complicated, probably more expensive to run. It's probably a good thing for them to do long term. It's yet to be demonstrated that it's an amazing net positive for shareholders. There's some companies, again, that have done it for a long time, like Prologis, where it's arguably been beneficial. So that's been an emerging topic that's important in the industry. I would say there's increasing signs that many REITs are adhering to their cost of capital. Apartment REITs, so I mentioned winners and loser sectors earlier. Residential has been broadly one of the sectors that's had a harder time last year and into early this year, both on the fundamental side with lessening employment prospects and challenges on the integration front, population front has a spillover effect to all types of rental housing across the spectrum. That sector has been at a big discount in the listed market to private values for quite a while. And so you're starting to see more activity that's in line with that kind of cost of capital. So in that kind of environment or that backdrop, external growth and acquisitions don't make as much sense as selling assets, maybe buying back stock. And so you're starting to see more companies, I would say, do a better job adhering to their cost of capital. And apartments is just one example of that. On the flip side, you have some of the winner sectors like healthcare and Welltower as an example, where you have this really tremendous cost of equity capital where they can go grow in a smart, diligent, disciplined way, but in scale with a terrific platform, a very strong operating platform. And so they've been able to really be on this virtuous cycle and treadmill of external growth, contributing to earnings growth prospects and coupling that with really terrific internal growth prospects because of the strong fundamentals and the really long runway for housing, which is Welltower's business, of course. So there's examples on both sides where external growth paired with a good cost of capital and then vice versa on the other side. So I think REITs need to do a good job adhering to their cost of capital. I think there's some evidence that starting to do more of that. There's also more focus on AI and optimization. I would say it's not moving the needle yet, but it probably will in the future. So there'll be more discussion on that going forward. And then a lot of boards are still addressing investor concerns about refreshment, succession planning. You have some new CEOs at some very large REITs in 26 here this year, Prologis and Public Storage. Boards are very actively planning for succession, turning over board members to just to make sure they're putting their best foot forward. And in case of both Prologis and Public Storage, outgoing CEOs there have done a great job. In the case of Prologis, an outgoing CEO that's a legend in the industry, and Hamid, and so very terrific career there, and wish him well. He'll move to executive chairman. So those are just some things that we see, some trends that are prevalent in the industry now in terms of how teams are responding.
And in terms of investors, what are the key things that they're focusing on when they're selecting REITs for their portfolio?
Yeah, I think a lot of things. I think back to the winners and losers comment across sectors. Sector really matters greatly to the investment proposition, and over 20 different property types that one can invest in via REITs. So it has a great determination on fundamentals. So it's every sector is a little different. Every story is a little different. Even within a given sector, every story is a little different. So there's opportunity to find the story, the combination of sector and company dynamics that makes sense for a given investor. And I would say it's been a good time to bet on both quality and growth. I think the industry used to have more of a reversion to the mean kind of aspect to it in terms of stock picking or what securities work. And that has not worked as well in the recent past. So I think betting on quality, betting on growth, I think earnings growth has become ever more important to the industry and to investors over time. We have more generalist investors, more passive investors, and fewer REIT dedicated investors in terms of percentage ownership in the industry. So I think those attributes have become important.
And what about pricing? You mentioned there's been M&A activity. How are current prices impacting transaction activity?
I would say just to take a step back. So commercial real estate values have been, I'd say, fair versus bonds for the last couple of years. So it seemed like a long time now where we've been stuck in neutral in terms of the outlook for property pricing. And we had declines of 20% plus, a few years ago after long into the curve, rates had climbed steeply, 22, 23. We've come back from that hole a little bit. Values have been climbing, as NOI growth has continued turning long. Still down 10 to 15% on average, I'd say. So there is a growing, I'd say, expectation for the idea that values in commercial real estate are well positioned to appreciate from here. That requires, I'd say, further rent growth, NOI growth, and as or more importantly, lower interest rates coupled with that. So in that context, I'd say transaction activity has rebounded pretty nicely across the commercial real estate industry broadly, not to the highs of the COVID 21, 22 when activity was just literally through the roof. I'd say noticeably higher in the 15% year over year range. So I'd characterize it going along with my debt market comments earlier, being the lifeblood of the industry. There's, I think, greater animal spirits in the marketplace now. Debt financing is there. I think the flows and the activity on that side of things are encouraging. So I'd say the private market in terms of deal activity has been perking up in the last 12, 18 months. And so I think that's an encouraging sign for price discovery and getting more investor dollars into the market and off the sidelines. And that's good for the industry, good for price discovery. So, and then within REITs, public to public M&A has been pretty quiet. Privatizations has definitely been a thing, especially for smaller companies. There's been a number of privatizations of smaller REITs that we don't cover at Green Street. And those are probably net good for shareholders. In many cases, there were some very large discounts to what the underlying property values were. So the market's doing its thing and being efficient in many of those cases and getting the best outcome for shareholders that's possible. So that's one of the benefits of the REIT vehicle in theory, is that those kinds of outcomes are possible and do happen.
And you mentioned earlier how the healthcare sector is really steaming ahead. Are there any other sectors that Green Street's particularly positive on right now?
Yeah, I mean, some of the sectors that are doing very well, it's easy to stand on the sideline and just be in awe of the performance and what's ahead. I think senior housing is clearly in that category. Data centers are also at the top of that list, but for very different reasons. Obviously, the demand drivers are very different between those two property types, but I think the senior housing just has this great NOI growth runway for existing property owners and shareholders. For cash flow growth, there's very low new supply. Still, the demographics that are ahead are still amazing over the next 5 years. We're going to be eclipsing all-time high occupancy and rent growth in coming years. And then on top of that, there's the great cost of capital to grow through acquisitions that I mentioned earlier. And Welltower and several others are doing that. I think for a REIT historian, I think the senior housing conditions and recent returns generated by, let's say, a company like Welltower, it's arguably, when you look back and look forward to what's ahead, I think it's arguably one of the greatest moments in the history of all REITs, senior housing / Welltower, in the last several years and the next several years ahead, just in terms of the absolute strength of the runway on the operating side of the actual real estate conditions, and then coupled with the smart capital allocation. So if you're a healthcare REIT, a senior housing oriented REIT in particular, it feels like a golden age here coming up. And then data centers is so different because the demand is out of control, crazy high, but the economics are mostly being captured through development. So that's the complete opposite of senior housing, where I mentioned there's very little new supply. And data centers, everyone wants to develop because the margins are very good. The demand is still outstanding with all the CapEx that the AI heavy companies are needing to spend, what they call hyperscalers in that industry, the big internet companies. So development there is really where the demand to put capital out has been, more so than on the existing asset side. The NOI growth profile for existing data center assets is good, but it's not nearly as good as what senior housing seems to be right now. Now, part of that's because senior housing has much more operating leverage. It's a more operating intense industry with much lower margins. So therefore you get more magnification on the NOI line for, call it, the same degree of revenue improvements. But that being said, yeah, the senior housing NOI growth profile is quite good. So the bad news is valuation wise, these two sectors have done very well. So they're not necessarily at the top of the what's most attractive today list when we look at how different REIT sectors are priced. But those two would stand out to me in terms of where the fundamentals are just absolutely impressive and sort of jaw-dropping to some extent.
Just staying on senior housing for a second, what about competition for assets if it's such a heated area? How's everyone competing?
The public market signal for a long time has been that very easy to predict that senior housing property pricing was going to keep appreciating. And you're seeing that in real time. I think even right now, there is a lot of interest and capital chasing the space through acquisitions, both private equity, public REITs, and cap rates are coming down, I think, in real time as we speak. But that's what the public market's been predicting for a while, so it's not too surprising. And so I think there is still opportunity, but if you're investing directly in senior housing, buying yesterday was better than buying today, and buying tomorrow is probably better than buying next week, because it is, I think, happening in real time. But I think there's still a runway for folks to put dollars out. It's hard to underwrite that business too, in the sense that the operations are so important. In the industry, the senior housing industry is really maturing in recent years, a lot of innovation. It's lagged behind historically some of the other more mature property types on the operating front. And so I think it's maturing itself in terms of the operating model in real time, both just through natural passage of time, but also through innovation by folks in the industry as well. So it's changing quite a bit in real time.
Mike, what about some of the less favored REIT sectors? Do you see opportunities emerging in any of those?
Yeah, I think some of the challenge sectors that we've talked about are pretty cheap, and the betting lines are very low. The bar is low. And frankly, patience is likely to pay off over some longer time horizon, even though they're not in vogue right now. Single family rentals is maybe the best example. Towers is another one. Both of these have been darlings at different times in the past, and now they're in the doghouse for various reasons, which we could talk about. I think gaming is another one where it's typically been cheap in our view, and it has delivered good shareholder returns over a very long time period. So I think those three are ones I would cite as things that are kind of in the doghouse now, where a long-term oriented investor probably has some margin of safety by investing today, but patience is definitely needed. On the other hand, there could be places like apartments that could potentially be near-term value traps, even though they're discounted arguably similarly to some of the other things I mentioned, and does screen on the cheap side. But I only put apartments in that category that if we get job growth decelerating further, that sector would probably suffer more than some of the other things I noted. It would feel the effects of all that sooner. Not to say things like SFR is resilient, but I think just the apartment sector would feel it probably faster, a little bit faster.
And let's talk a little bit about the retail REIT sector. How is that faring? Are you seeing a resilient consumer, and that job growth that you mentioned earlier, is that going to impact results?
It's a good question. Just to take a step back, how has retail done? It's done really well in the last few years. Just for example, malls have posted something like a 25% return in recent years, and in the high teens over 5 years. So pretty heady stuff. Strips are near the top of the group this year. Their long-term returns have been pretty good, above the REIT average in recent 3 and 5 years. The outlook for brick and mortar has, I'd say, brightened quite a bit in recent years. And I can remember when we first turned positive on malls a few years ago, I pound the table with both fists. Simon, the big mall REIT, was, I don't know, I may have my numbers wrong here, but it was maybe $80 a share and a 9 implied cap rate or something. And at the time, there was still a lot of fear about malls. And I can remember some people at the time would look at me like I had 3 heads when I was pounding the table with both fists. But now it's $200 and a 6 implied cap. And so the bad news is that both strips and malls are less cheap today, less attractive today, arguably, than in the past, but they have a lot of merit for investors. The outlook is really good. Retail has become a strength again in the commercial real estate world. So it's funny how things change over time. And both of these sectors have gone through arguably two different 100-year floods in the span of just 7 or 8 years, the e-commerce boom and then COVID. Both of these sectors came out on the other side and then blessed with a backdrop of almost no new supply. Rents are far below replacement rents. Retailers, and this one's really important, retailers have really been recommitting in recent years to the importance of high quality brick and mortar space in their corporate strategies. Consumers have been spending money at high quality malls and utilizing strip centers quite a bit post COVID. I'd say retail continues to have a really good outlook. Quality is going to winner in the space. The retailer demand for space is good. Occupancies are at near all-time highs or at all-time highs. Bankruptcies, when they happen, have not been as problematic or as frequent. And when they do happen, the space tends to get absorbed more quickly and at better economics than in the past. That was always a recurring problem for strip centers in the 2010s, let's say, for example. So I'd say rent growth prospects are very good, but not gangbusters. NOI growth looks pretty reliable. So we feel pretty good about the foundation that's been laid here, and leasing has been really good across high quality malls and strip centers. The foundation is there and it's really good. So to your question, what if the consumer weakens? I think the resiliency of the consumer is one thing. There are stats you can cite that show weakening consumer, and that's concerning if employment growth stalls. I think the important thing in all this, though, is that I really do believe the retailers have opened a brand new chapter in recent years with respect to their commitment, more or less, to the importance of brick and mortar. So I think it would take a pretty nasty downturn to really knock this thing off kilter by quite a bit. Malls in particular is one of the more economically sensitive sectors. There will always be that concern, and short-term trading could reflect that if things go poorly on the news front related to any of these important variables. So maybe I'll leave it there.
Michael, any issues that you see flying under the radar, maybe not getting talked about much, that you think could impact REITs going forward?
I think the AI impact could potentially be big in coming years. If it does, it impacts employment growth. It seems like there are signs that suggest that could happen, or that we're, in the beginning stages of that. So I think it's something we're all keeping an eye on. I think just this broader idea that could cause GDP growth to detach from employment growth, historically joined at the hip to some extent. If those diverge, that's arguably not good for, let's say, office, not good for high-end apartments like the REIT zone. As we just talked about a minute ago, maybe there would be some negative impact on the sentiment for retail, even though, as I mentioned, I think the retailer side of things would hold up decently well and help those mall and strip space do okay. But so I think that's a concern that I think we're in the top of the first inning and we don't know how that's going to play out. But that's almost, I think, maybe the most important concern that one could think about, probably.
And for anyone considering investing in REITs today, what would your advice be?
I would say REITs are really a great proxy for investors to access the commercial real estate market. You get liquidity, usually reasonable costs and alignment of interests, a great diversity across a plethora of property types that is really hard to replicate on the direct side of the business. Good luck to a family office trying to build a giant data center or invest in outstanding platforms and all these different property types. So there are a lot of benefits to REITs. And I think over the long run, they behave like property investments, even though they are naturally stocks in the short run. But over the long run, they should behave like property, and they should offer reasonable inflation protection. They've greatly trailed the S&P over the last 10 years. Which has been a challenge. But over the very long term, I think they tend to offer the attributes that investors want: diversification and exposure to a different part of the economy that can be hard to access. And so I think they deserve a place in the portfolio. I think someone getting into REITs now would have the benefit of the recent underperformance versus S&P in recent years. Betas have been coming down recently. So I think it would be a good time for someone to establish a position in REITs in an asset allocation model. We're not market timers, so it's not our bread and butter, but do believe that as folks think about asset allocation, that REITs are worthy of consideration. They're a great vehicle for investing in commercial real estate.
Michael, thank you so much.
Thank you.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.